Welcome to Swing Trade Pro, a three-part educational offering from Pivot Boss with Frank Ochoa. I'm extremely excited to bring Swing Trade Pro to you. This course is by far the most extensive training that I've ever developed for swing trading, and I'm certain that you'll come away from this course a more confident, knowledgeable, and profitable swing trader. The course includes three powerful sections that are geared toward teaching you the essential knowledge needed in order to excel in swing trading. Part 1 introduces foundational swing trading concepts. These will lay the groundwork for the rest of the course. Part 2 will teach Pivot Boss entry techniques and swing trading setups. And Part 3 will tie the entire course together with trade and risk management. We've got a ton to cover in this section, so let's go ahead and get started with Part 1, Foundational Swing Trading Concepts. The four market phases. This is how we're going to start this course. These four market phases basically give us the structure by which we'll trade from the rest of the course. But first, let's talk about the personality of markets theory. The personality of markets theory, PMT, states that stocks tend to cycle through various personalities over time. Your goal is to only trade during the most favorable cycles, as these cycles provide the best opportunities. Essentially, a well-behaved personality is likely to remain well-behaved until it proves otherwise. That means a stock that trends very well, a stock that adheres to typical market structure, will likely continue to do so until proven otherwise. On the other hand, a volatile, unstructured personality is likely to remain as such until it proves otherwise. That is, if a stock is volatile, it has no rhyme or reason, there's a lot of volatility, whipsaw activity, it's likely going to remain that way until proven otherwise. It's also important to note that instruments will gradually switch between phases over time. So a stock's personality today will not be the same personality likely 6 months from now. They shift and go through phases over time. So if we're looking at a stock chart here of Boeing in a daily time frame, you can see that volatile personalities make it difficult to forecast future price direction and behavior. I mean, if you're looking at this chart, it's so volatile. There's a lot of crazy swings back and forth. It makes it very difficult to figure out exactly what's going to go on in the upcoming period of time. That makes trading exponentially more difficult than it needs to be. Instead, you should focus your sights on trading well-behaved stocks. Well-behaved price structure helps you better anticipate future price movement. And a bonus is that the clean trading, the clean price movement that is usually occurs within a well-behaved price issue usually facilitates more profitable trading. There's not a lot of crazy whipsaws. When you're in a trend, you're in a trend. When you're in a sideways range type of market, you're in a range market. But you can tell what's going on and you can anticipate upcoming moves because the issue is well behaved. So now let's talk about four market phases. And this is important because the personality of markets theory really says, you know what, trade only the best issues. And I know that is a silly thing to say because everybody knows that. Everybody knows, well, you know what, I'm not going to trade the crap. I'm going to trade something that looks nice, that trades well, that adheres to typical market structure. But so often is the case that traders have an itchy trigger finger and they will trade anything that moves. And in this case, when it comes to trying to become a consistently profitable trader, what you want to do is trade only the best of the best because it leads to better and more profitable trading. So when we're talking about the four market phases here, we're going to learn the four phases of the market by which typical market structure usually adheres to. And the four market phases are accumulation, distribution, markup, and markdown. And these four market phases were pioneered by legendary trader Richard D. Wyckoff. And basically, these cycles help provide an understanding of the various periods or phases that price goes through. And when you're able to understand those phases, you can understand the cause and effect of what will happen with price. And that leads to better market timing. So what these phases do is they give you a heads up on the potential upcoming market phase. This allows you to anticipate and prepare for upcoming price movement, and those traders that can recognize market phases are able to identify the best profit-making opportunities. And depending upon the market phase, you're able to tailor your approach to the phase. And this is going to be extremely important throughout the remainder of the course because we're going to focus on these 4 phases for how we approach the market. Now, if we look at a quick graphic, a picture is worth 1,000 words. When you look at this graphic, you can easily see what accumulation, distribution, markup, and markdown are. Immediately, you can see that accumulation occurs ahead of an uptrending market, ahead of a markup. The accumulation phase occurs when institutions are buying up large amounts of shares, but they're doing so at a slower pace so as not to influence price too quickly. They're trying to keep it down here so they can get a whole bunch. They're accumulating their inventory. And then once price is ready to go join the markup phase, you see an uptrending behavior. After that markup phase is over, you see distribution, whereby those institutions are liquidating their profitable positions, again, at a slower pace so as not to influence price. And once we get a breakdown, we go into markdown mode, which is the downtrending phase. And then it just starts all over again. And this is the typical price structure that occurs in the market. We're going to dump into each of these 4 market phases in greater detail, but the idea of the entire course is the accumulation and distribution phases are a necessity. They are the fuel that leads to a big markup or markdown period. The greater the period of distribution or accumulation, likely the greater trend we have afterward. And if we can identify those periods of distribution, we can then identify the easiest times to trade during those trending opportunities. We buy value on the way up and you sell premium on the way down. So we're going to discuss that throughout the course. So if we look at the 4 market phases in an actual chart, you can see this daily time frame of FLR. You show a clear and clean markup. Very nice uptrending behavior. There's never any doubt that the price is trending up. You see a blow off top here, typically called a buying climax. That buying climax tells you that buying is likely over. The automatic reversal that occurs here, the automatic reaction, usually sets the framework for the distribution to come. Then you see a period of distribution, lower and lower highs. Eventually you get the downside break, a period of markdown where the trend is never in doubt, it's going down. After that, you see your selling climax, automatic reaction or reversal here, which sets the framework for the accumulation phase. You build out into an accumulation phase, and from there you get an upside break with a markup that follows. That is typical price structure. That's the psychology of the market. That's how the market moves and behaves. Now, as you saw with that volatile stock that we saw earlier, Boeing, I believe it was, not every stock does that. The personality of a stock will change from time to time, but it's your job to trade only those issues that are adhering to common market principles. And if you do that, you're able to identify buy and sell zones with the best of them and continually make money in the market. Now, what we're going to talk about in this course is deploying actionable trade ideas during the markup and markdown phases, and only trading during those phases, and primarily trading during those phases after a significant period of distribution or accumulation. So here you see a very clear phase of distribution. This markdown phase we want to participate in because this was a nice clean distribution that lets us know that once it gets going in that direction, it's going to keep going in that direction until you see that selling climax. The same thing here. We're likely going to see a very nice period of uptrending behavior after a period of accumulation. So these markup and markdown phases oftentimes offer the safest bets for trading because you can expect what's going to occur, and during those trending markets, it's easier to identify discounts and premiums. So let's talk about the first phase, which is the accumulation phase. The accumulation phase occurs when institutional investors begin buying up substantial supply of a given stock. This creates compression and usually leads to a markup phase. So what are institutions doing? Basically, they have the most money. They see value or potential value in this upcoming move, but beforehand, what they want to do is behind the scenes buy a ton of stock. They want to accumulate their inventory of that stock, but they have to do it over a longer period of time. If you look at this chart here, Goldman Sachs or UBS or whoever, institutions, they see a value in the stock. They can't just buy 10 million shares here or 10 million shares here. It's going to move the needle way too much. So they have to buy, a couple 100,000 here, a couple 100,000 there, a million here, or whatever. They have to spread it out over a period of time so as not to influence price too much. And once they have accumulated their share, retail joins in and a markup period ensues. But they're already in at the bottom. So that's what the accumulation phase is. The institutions are putting gas in the car before the car can begin its journey. And that's how we have to see the accumulation phase. You have to see it as the fuel that leads to a profitable markup period. So if you're able to recognize the accumulation phase, it gives you insight into the future opportunity of that issue. And Wyckoff believes that this phase is the force, the fuel behind the upcoming move. So accumulation is fuel. The accumulation phase should be seen as a necessity in order for an established market phase to develop. The bigger the accumulation, the bigger the markup. So you can see right here in this AEP chart that price basically accumulated for 1, 2, 3 months, right? A 3-month accumulation phase where it was going nowhere except for being accumulated. And then that breakout right here and the subsequent retest here led to an overall markup phase that lasted 1, 2, 3, 4, at least 4.5 to 5 months. You can see that this was the fuel that led to this explosive move. Once you get into a markup phase, every one of these pullbacks becomes a buying opportunity. You buy discounts on the way up, discounts on the way up, discounts on the way up, and you sell at premiums on the way up, right? That is the goal of the course. Identify the accumulation phase. Once you get that breakout, identify the highest value opportunity plays during the markup or markdown phase. Identify value. The cornerstone to profitable trading is understanding market structure and understanding the concept of value. If you can do those things, those two things, you can and will be a profitable trader. Classic accumulation, you can see here, again, many months of going nowhere, sideways, very clear support, very clear resistance. Price is just basically coiling, being accumulated. And then once it's ready to move, it's ready to move. And once you see that markup phase come out of that accumulation phase, these points become the buying opportunities. High probability reversal opportunities right here. This is an outside reversal candlestick pattern that leads to an explosive 2-3 week move. Again, a hammer reversal candle, several of them in a row in a range holding the overall uptrend. Boom, that's the buy the dip opportunity that leads to a premium sell opportunity up here. That is the goal of the entire course. And the good news is you're learning these initial foundational concepts now, and we're going to pound them the rest of the course, showing you how I identify these areas to buy and sell using the tools that we'll be learning in the course and the concepts and the techniques in terms of setups, in terms of entry approaches. I'm very excited for you to see the entire course, the entire 3-part course. is tailored in a way that it just layers this information on top of each other so that you can do this in your sleep. That is the goal. Now, of course, after you get a period of accumulation, you get that huge lift-off move. Sometimes we don't get a beautiful markup period that just continues to trend higher. Sometimes, after a journey, the car needs to refuel at the gas station one more time before you get another move. And that is called reaccumulation. The reaccumulation phase helps to extend the overall markup period. The only thing is sometimes this reaccumulation phase can sometimes look like a distribution phase, and that can be tricky. But there was no buying climax here. There was no buying climax to set the stage. No whipsaw reversal that was, the automatic reversal that helps set the other boundary. None of that. And that's usually your first clue right there that this is not a distribution phase. It's instead an accumulation phase. The other thing, look how it's trending up. Higher highs here, higher lows here. This one comes back to the prior high, but that's a higher high, a higher low. New high, higher low. So it is actually kind of, the reaccumulation phase is kind of sloping upward. That's another giveaway as well. But this can happen, so you have to be aware of it. Now the markup phase. The markup phase occurs after a period of accumulation and usually leads to a sustained trending move. This phase provides the best opportunity for trading. After you see a breakout from an accumulation phase, a nice, robust accumulation phase, that's usually the expansion after the contraction. If you've read my book, Secrets of a Pivot Boss, if you've followed my commentary on the website, pivotboss.com, if you bought any of my other courses, you always know I talk about contraction and expansion. Contraction, expansion, or compression and expansion. It's range contraction and range expansion. That's how the market operates. When the market compresses, it's like a coiled spring. It's coiling, it's coiling, it's coiling, and once it's done coiling, that breakout leads to the range expansion. That's what we're looking for. We're looking for the accumulation phase to provide the contraction and for the markup phase to provide the expansion. And when you have a markup phase like this, you buy the dip, you buy the dip, you buy the dip, you buy the dip. You sell at the premiums. And that's the goal of the trade. Or if you're a longer term trader, this is swing trading concept, so we're looking at 3 to 10 day moves. But if you're a longer term trader, you can use a weekly chart. You can get in on this break and you can just hold it for 3 months. That's position trading. So you don't have to get in at the dips here. You can just get in one time and hold it using a weekly time frame or a monthly time frame or whatever you want, or just hold it because you're that confident that a period of markup will occur after a period of accumulation. So price breaks out of accumulation phase and begins to trend higher. That's markup. The big money bought during the accumulation phase, and now the retail trader joins in, right? The retail trader joins in. They say, hey, there's some strength here. I'm going to buy, I'm going to buy, I'm going to buy, and it pushes price up. Demand increases for that stock. And when demand increases, value increases, right? Price goes up. This is the most profitable time to buy and also the safest time to buy. And according to Wyckoff, he believes that this phase is the direct result of the accumulation phase, and one of his rules is to only trade during a markup phase and only trade during a markdown phase, which we will be adopting. Here's a classic markup, and I love this markup because this is one that I remember seeing in real time. I remember looking at Apple with my friends back at the trading room at my prior company, and I remember this period right here. $80, and I kept remembering thinking, wow, institutions are pounding the 80 here, they're pounding 90, but price isn't moving. But you can see, look at the accumulation, look at the giant volume here compared to normal. This volume was being accumulated, and Apple just built out for about a good 6 months. That's a 6-month period of accumulation almost. And once it broke to the upside, I remember telling the rest of the folks at the trading room that we're about to see a big move. And I remember thinking we're probably going to get a move to about 150, maybe 170. And as you know, this accumulation led to a move of what, over 500-600 bucks eventually. But this markup phase right here, I don't know anybody who did not know that price of Apple was going up. Everyone knew that this was an established markup phase. Everyone saw the same pullbacks, and people bought. And I remember just writing, commentary that says buy here, buy here, buy here. And that's just what it is. It's looking at the accumulation phase, understanding what this means, understanding that this is the fuel that leads to the move. And if you can do that, you can then identify those periods of time when you're likely to see those nice, glorious trends, and you can identify the discount opportunities along the way. So they make for the best trading opportunities. When you have a very nice established markup phase, you can use any tool to identify pullback opportunities. It's all about using the right tool and using that tool in the right way. And when you can do that, it becomes very simple to identify these pullback opportunities. You can use candlesticks, you can use moving averages, you can use VWAP, you can use pivot range concepts, you can use whatever you want, basic trend lines. It's just knowing what to expect, knowing when price is undervalued so that you can buy it and sell it for a premium. And that's all it is. And we're going to discuss my favorite ways to doing it, my ways that will basically give you a head start into adopting these concepts, profiting from these concepts, and then growing as you tailor the approach to your style, your methodology, tailoring it according to your increased experience level with using these concepts. Transition to markup. This is fantastic because if you have a very clear period of accumulation and you know that as soon as we get that breakout, we could have an enormous trend on our hands. If you can capture the entry from the transition from accumulation to markup, you probably have the low of the trend. Triggering that entry can be extremely profitable. And that is easier said than done. But when you have a breakaway gap like this here, where price is down here at around 1575, then we get a gap up above 1650, that's out of range, out of value, increased volume, most likely, and then price comes down to retest the range and immediately is bought by responsive buyers. Initiative participants are going to begin moving the price higher. All of this is a perfect storm for an amazing move. And this is something that we're going to talk about in part 2 of this course, and how to trigger this entry. How to trigger this entry and get an amazing price. But if you can capture that move, you could likely get the start of that move. And even if you do not, because that's not the whole goal all the time, even if you do not, you can then learn how to trigger this entry or this entry. All right, the distribution phase. The distribution phase occurs when institutional investors begin slowly liquidating, selling their inventory of a given stock, thus creating compression. And this usually precedes the markdown phase. So after a beautiful, glorious markup phase, institutions will begin liquidating their profitable positions. That means they're selling large amounts of that stock, but they're having to do it over a longer period of time so as not to disturb price. So up at these highs, institutions are selling, 200,000 shares here, 400,000 shares here, another 150,000 here, maybe a million here. We got 700,000 here. But overall, they just held 5 million shares. But they've had to slowly liquidate it over a period of time, because if they would have just said sell 5 million, sell 2 million, you're going to get this immediately, and all of a sudden they're having to sell it all the way down, and it's completely ruining the profit they've made. So what they have to do is they have to build this up over time. That's a distribution phase. Once you get the downside move out of there, out of that range, you usually get a very nice established markdown phase. This is the contraction before the expansion, right? And identifying this ahead of time gives you insight into the future opportunity of this issue. With experience, you'll be able to see that this is truly a distribution phase. And instead of getting in down here upon a breakdown out of this range, instead of getting in here on a pullback or here on a pullback, you'll be able to get in on these wicks here, here, or here to hold into a longer position, or to get in here or here to have steam into the move already. You'll be able to get in here or identify that this is a high probability opportunity. This is a high probability opportunity. That's the goal, to understand the market phases so much so that you know exactly what to expect. And when you know what to expect, you know where to trigger your entries and set your stops and set your targets and set your trailings. It all comes together, but it comes together by a proper understanding of market structure. Again, Wyckoff believes that this phase is the force, the fuel behind the upcoming move. When you're looking at a distribution phase in an actual stock here, what you see is very clear sideways move here. And I remember always being taught early on that if you consolidate at a high after an up move, that's usually a continuation pattern. And those are usually called consolidations. But this is not a consolidation. And that's the difference. This is not a consolidation. This is a distribution phase. This is a topping pattern. You see this rounding off behavior right here? That's a saucer. That's a rounded top right there. And this behavior tells you that this is a distribution phase. Now that doesn't mean that we can get a fake out and just rally through a high, because, you know, like in life, anything can happen in the stock market. But more often than not, this is not a consolidation that's going to lead to more strength. What this is a topping pattern. This is a distribution pattern. This right here is a buying climax. The buying is over right now, and now everybody is trying to get out. They're trying to book their profits and move on to the next opportunity. And when that happens, that's when you get your breakdown, and that's when you get your downside follow through via the markdown phase. And of course, every pullback in that down move becomes a selling opportunity. The distribution phase also comes with a redistribution phase as well. Just like the reaccumulation phase, you have the distribution phase here, you got the downside break, and then price redistributes along the way before the next move down. Again, this can be difficult to decipher whether it's, this is going to be an accumulation phase or whether this is going to be a redistribution phase. But one of the things that helps is that you're not usually going to begin an accumulation phase after such a short move down out of a distribution phase. This is too short a move. If this had been just a complete downtrend all the way, and then this range right here began to form down here, maybe that could be an accumulation phase. But this right here, it usually indicates that this is just a resting point. We're going to redistribute here, and then we're going to extend the markdown phase. Another thing to distinguish whether a distribution phase is distribution or accumulation is the way in which it forms. You have a downward sloping manner to it. Even though it's happening at the overall highs, each successive high is lower than the prior high. Each low is becoming lower than the prior low. That right there immediately tells you that things are not that good right now, and we're likely going to start a beautiful markdown phase. So if you get those series of lower highs and even lower lows, that tells you right there it's starting to tip its hand. That's the tell that lets you know that we're likely going to get a down move. Again, That doesn't mean it always happens. If we could certainly break up from here and keep going. This could just be a flag pattern, right? But that's not always the case. This is usually a good tell that we're likely headed lower. And of course, even if you wait for this move right here to confirm the move, that's okay because you can then find those pullback opportunities and take advantage of high probability moves. The goal is not to capture this entire move. You could if you wanted to, but that's not the goal. The goal is to identify high probable opportunities, high probability opportunities within established phases. So being able to identify this pullback and capturing this little move, getting out, and then being able to identify this little bump and getting this little move, and then getting out, and then being able to identify this and capturing that little move and getting out, that's perfectly viable. And we're going to learn those concepts. Now let's talk about the markdown phase. The markdown phase occurs after a period of distribution and usually leads to a sustained trending move. This phase provides the best opportunity for trading. Price breaks out of distribution phase and begins trending lower. That is the typical structure. When you're trending lower in that manner, again, it provides the best possible phase for you to make money in. It high probability, unidirectional. You know that price is likely headed lower, so why buy? Why try to be the smart guy that buys low and tries to sell high? Instead, sell high and just try to buy back lower, right? You're shorting pullbacks on the way down. This is the most profitable time to sell short and also the safest time to sell. And according to Wyckoff, he believes that this phase is a direct result of the distribution phase that preceded it. And if you can get a beautiful distribution phase, you're likely going to see a very nice markdown period. How much fuel are you going to put into the car before the next move? If it's a teeny tiny little distribution phase, then you see a teeny tiny move. If it's a glorious, beautiful distribution phase, you're likely going to see a glorious, beautiful markdown period. So this is what we're looking for here. This is a period of distribution. This one actually happened to be kind of sloping upward, and then this lower high here led to a break. Clearly this was a distribution phase. And then getting that first pullback to the lip, that prior support, that's your retest. The market is retesting to see if there's any interest at all whatsoever to go up. And when it fails at that point and people pile on, it's almost like shooting pullbacks in a barrel. Boom, you get in on that one. Boom, you get in somewhere right here. Boom, you get in at the next pullback after that dropped to 2,500. It becomes easy. And this pullback right here leads to this quick move. You sell it, you cover here, or you can cover here, and then you wait for the next pullback. And here's the pullback. You get in somewhere up here. You can get amazing entries. And I'm going to teach you my pro style entry techniques in part 2 of this course, whereby you're actually going to get in on this wick right here if you wanted to. And I'm going to show you how to do it so that you're capturing a move that goes from here, this price point, and taking it down to down here and getting out somewhere right about here. I mean, you're going to maximize the types of moves you get. But it all starts with building up your foundation of how to understand market structure, how to understand these zones, and then how to identify those profitable areas that you can, deploy your actionable trade setups from. Here's another markdown period where you see a smaller distribution phase here. The blow off top here, the buying climax, boom, the automatic reaction sets the stage. Another blow off top, boom, and then of course you get the markdown phase. Here, another buying climax, boom, boom, automatic reaction, holds down here and builds out a framework. When we get the breakdown, all these pullbacks become game, boom, boom, and you get the nice move. So once you understand this market structure, you understand what price has done for centuries. I mean, these concepts were developed by Richard Wyckoff 100 years ago. He was a legendary trader during the time of Jesse Livermore and other greats. These are the concepts that have stood the test of time, and they're going to continue to build in this manner. So once you understand them, do you really need a setup to trade these? No, you do not need a setup to trade this. You just need an understanding of market structure and value. If you understand value and discounts and premiums, and you understand how the market moves, you don't need a setup. You can just see the chart and know this is when to buy, this is when to sell. Now, of course, everything's easier with a setup. So I'm going to teach you some setups. A ton of setups, as a matter of fact, in part 2. But eventually what you'll find is you won't need those exact setups, because what you'll know is value and market structure, and those will lead to fantastic buy and sell opportunities for you. That's the goal, for you to know this so well that you'll always know when to buy and sell. So after taking a look at the 4 market phases and understanding those 4 phases, I mean, we've just had an in-depth discussion about them. From those phases, we have our axioms, our Swing Trade Pro axioms that we're going to use for the remainder of the course. Many of Wyckoff's basic tenets have become foundational standards of technical analysis, including the concepts of accumulation, distribution, and the power of price and volume in determining price movement. So what Wyckoff described 100 years ago still holds true today. And because of that, we have 3 axioms by which we will basically have the laws that we will use the rest of the course. And the first one is the best price moves occur when there has been enough time to allow for a period of accumulation or distribution. Understand that and seek out those instruments, those stocks, those futures contracts, those ETFs. Seek out those instruments that are in an accumulation phase or distribution phase, because then you know what to expect coming up, and you know how to attack that markup or markdown phase that follows. Axiom number 2 is only trade during the markup and markdown phases. If you can limit your trading to only the highest probability opportunities, you're going to become a consistently successful trader. Buy pullbacks during the markup phase, discounts. Sell pullbacks during the markdown phase, premiums. If you can limit yourself to only buying discounts and only buying premiums, that is the fastest path to consistently profitable trading. Imagine if you only bought things when they were on sale, how much more money you'd have. If you only sold things when they were at the best times to sell them at that point in time, you're going to have more money. Apply those principles that you apply in your everyday life to the stock market, and you can become consistently profitable. The third axiom, avoid trading during periods of accumulation or distribution. Don't do it. There's no edge. I mean, yes, you can trade in those zones. There's nothing wrong with trading in a trading range like that or those periods. But if you can avoid those periods, you're just saving yourself headaches. You're saving yourself money. Your bottom line is going to include more money if you avoid trading during those periods of time that do not offer the best times to trade. They're not the most conducive periods of time to trade. So these are the 3 axioms that we'll be using for the rest of the course. Now let's talk about value. We have market structure under control. Now we're going to talk about value, because the first part of being successful in trading is understanding market structure. What does the market typically do? How does it usually move? What is it doing when it's in this phase or that phase? Once you know that, then it's time to tackle value. And you know that in each of these courses, I talk some about value because it's all about value. If you can understand value, if you can pinpoint when something's at a discount or something's at a premium, that's life lessons. Those are life axioms right there that you can carry with you in any phase of your life. You'll always know when to sell your business because you understand the value. You'll always know when to buy someone else's business because you understand value. You'll always know when to buy that condo. You'll always know when to buy this stock at the right price or when to sell. And that's important. So professionals understand value. And I know you do too. It's just being able to apply that understanding to the stock market doesn't always translate as easily or as quickly as you'd like. But it does translate exactly the same way. And once you understand that, once you make that connection, you'll know exactly what to do time and time again. Professionals rely upon their ability to identify value opportunities, and they exercise discipline to only trade when good value is present. Quickly and accurately determining value directly affects profitability. If the quicker you can identify value and be accurate about it, that will affect your profitability. Hands down. In a positive way. Patience and discipline are the keys to consistently trading value opportunities. And that's the biggest thing right there, is the discipline part. And it's the patience that you have to have in order to only trade when those opportunities, when the best value opportunities are present. That's the part that a lot of traders have. That's what stops people from being consistently profitable. It's that you're not disciplined enough to only take the best opportunities. Yes, you'll do it for a period of time, but then what happens is that, hey, this one was flying through the roof. I wanted to participate. Looked like the market was about to rally. I'm getting in, and all of a sudden you get caught in a bull trap. Well, this one's gonna come back. So you take off your stop, and you're like, you know what? I'm just gonna let the stop off because I know it's gonna go higher. Well, it doesn't, and now your stop's gone, and it's going lower. And now it's like, well, maybe I'll let it pull back and I'll take a smaller loss, but it doesn't. It keeps getting bigger. It's discipline. That is discipline. If you can just do the right things and only the right things, you will be consistently profitable. That's what makes a professional trader, is that they approach trading as a business. And you do certain things because that's what you do in that business, and you avoid certain things because that has no place in this business. If you require good value for every trade, your odds for success dramatically improve. If you're only buying discounts, you're going to do better. If you're only selling premiums, you're going to make more money. Trading value reduces risk and maximizes the potential gain. Right? If you only trade by buying discounts and selling premiums, it's going to reduce your risk because you're closer to your stop loss. So you're putting less risk on the line. But you know what? If that trade works out, you're in at the ground level, and you get to say when you sell it for a premium because everybody wants it. So now you're maximizing your gain. And so much good comes out of trading the right way. Now, of course, every single time I talk about value or I talk about market structure, I have to include this slide about auction market theory. Some of you may be tired of auction market theory, but it's these ideas, these concepts, these bullet points right here that basically give you a picture of what the market is about. If you can understand these points and they're in your brain every time you're looking at the market move up and down and you're watching a price chart, if you're watching price movement during the day, if you have these axioms, print this slide up, tape it up next to the chart, and you have these concepts in mind when you're watching price move, that's when you begin to understand what the market is doing. So then you can understand when to buy and sell at the right points. Auction market theory allows traders to make decisions based on market-generated data that is a reflection of supply versus demand. Basically, the market operates solely to facilitate trade. That right there is number one and always will be number one. The market operates for one reason and one reason only, is to facilitate trade between buyers and sellers. So price is going back and forth in order to satiate or facilitate that trade. Price is a tool used to advertise value. Keep that one in mind also. When we're talking about value, what we want to do is buy discounts. That's price levels below value. We want to sell at premiums. That's price levels above value. What is value? Well, price. Price is the tool used to advertise value. Price auctions up to motivate sellers and down to motivate buyers. Price auctions higher until the last buyer has bought, and auctions lower until the last seller has sold. And when buyers and sellers finally find that agreeable price, they trade in large volume because they're happy, and that establishes value. If you understand this and you understand the market structure, you know what the market's doing. You can understand exactly why price is doing what it's doing right now, and then you can take advantage of it. And here are the value basics that you need to know in terms of what value is and what are its characteristics. Professionals assess value in order to identify when prices are at a discount or at a premium. Identifying value is the cornerstone to profitable trading. If you can always identify value in your chart, you always know when price is at a discount and at a premium. If you can identify where value is in the chart, all you have to do is look below that value line, and you know whenever price gets there, that means it's on a discount because it's currently in a markup phase. Right? Price is used as a tool to advertise value, remember. Same bullet as the last slide. But here's the thing that makes it tricky. This is why it's so difficult sometimes to understand value. It's because value is the dominant variable in the markets. It is the variable in the markets. Variable meaning that it changes, and it changes all the time. Every time price moves, value is changing because the market, the collective minds of the market have differing opinions, and their collective opinions lead to what value currently is. And here's another kicker. Price is valued differently in every time frame. Right? So value in a 1-minute chart, there is value in a 1-minute chart, there's value in a 5-minute chart, value in a 15-minute chart. Value will change. That value in a 1-minute chart will be different than the value from a daily chart or a weekly chart or a monthly chart. So not only do you have to understand value, you have to be able to understand that it's changing all the time, and that because it changes all the time, it's also changing in every single time frame. The good news is you don't have to know the value in every single time frame. You just have to know the value in the time frame you are trading. You can even hop up a level and look at the value in the one time frame higher than you're trading, one time frame lower, so that you're always jiving and you're always trading in unison with those. But as long as you know value in the time frame you're trading, you can be profitable. But you have to understand that value is different across time frames, and it's always changing. The other thing to know about value is that historical value maintains significance into the future. So where value was calculated in a prior period of time can still be very significant heading into the future, because price and the market will want to retest those prior value zones. And if the test passes, that's a good jumping off point to move higher and further price discovery. If the test fails, that basically loses confidence in the current move, and then you see a downside move. So historical value can maintain significance. And of course, the last 2 points, demand drives value and change in value reveals demand. It's all about supply and demand, right? The less supply, the more demand, the higher the price. The more supply, the less demand, the lower the price. That's what it's all about. That's the market. That's the market for every single product or thing you see with your eyes right now. If you look around your room, every single thing has a market. and every single thing has supply and demand attached to it. What we're doing is looking at the supply and demand of stock prices. Professionals look to buy undervalued opportunities, and these are discounts, and they sell overvalued opportunities, and these are premiums. That's just the way it is, and if you can do that, you can be consistently profitable beyond whatever you ever thought you could. Discounts and premiums. This is a very important section that I'm excited to talk about, because I always talk about these opportunities in my other courses and in my analysis that I write up for the website. But discounts and premiums, I wanted to make it an official thing so that you can understand it, and I'm going to point it out on all these charts that we look at. We're going to start looking at charts here in a second. But I want you to have these words kind of ingrained in your brain. So every time you see a discount, you attach the word discount. So when price pulls back from a high and it's in a markup phase, immediately you look at that pullback, and what you think in your brain is discount. That means price is on sale and you want to buy some. And when price is at a high or a new short-term high, that's a premium. And you want to sell at that point. You want to sell at a premium, whether it's shorting to establish a new position or whether it's selling to liquidate a position. That's what you want to do with a premium. You want to attach that name to it. So you're always thinking in terms of discounts and premiums, discounts and premiums. So what I've done here also is you can print this slide out. You can cut up this little square here, these little rectangles, and paste them to your trading wall. And now you always have these ingrained in your brain. So a discount is any deduction from the nominal value. And basically I have bullet points here. Cheaper than fair value, that's what a discount is. Excess supply, decreased demand. And the goal is always to buy below fair market value. That's a discount. Always buying below value offers the quickest path to consistent profitability. Buy discounts during markups. That's going to be our strategy for this entire course. And you cover short positions at discounts during markdowns. On the flip side here, you have premiums. A premium is any sum above the nominal value. Number one is more expensive than fair value. So price is more expensive than fair value. That's a premium. Low supply, increased demand. The goal is to always sell above fair market value. That's your goal for this course. Always selling above value offers the quickest path to consistent profitability. If you can do number 4 on both discounts and premiums, that's your goal for trading, always and forever. Short premiums during markdowns and liquidate long positions at premiums during markups. So these two concepts will lead us through the rest of the course. I mean, this part 1 of Swing Trade Pro is called Foundational Swing Trading Concepts. And every single one of these is something that will be a foundation for your swing trading approach, but for your approach for everything you do in the market. Because what I love about the style and the concepts that I teach, whether it's through my book, my ebook, my courses, my live webinars, through the blog content or analysis that I post on other websites, through trading rooms, every one of these concepts is what you can use in any time frame for any style of trading, for any instrument. These are just market principles that you can take with you into your intraday trading, into your long-term investing, into your position trading, into trading Forex or trading stocks or trading options. All of these principles that we're talking about here, you can take with you. You fold it up and put it in your pocket and you take with you, because these concepts will last the rest of your trading career and beyond, because these are solid market principles. So this takes us to 5 simple value rules, and I'm just kind of giving you a concise version of what we just discussed. The 5 simple value rules help train your mind. We're training your brain. We're reprogramming the way you think to only trade during periods that offer the best odds for success. Don't make things harder than they have to be. I am not going to sit here and tell you that I can look at any chart and trade any move I want profitably every time. I don't have to. If I look at a chart and I can't make heads or tails of it, I move on to the next one, of which I can tell heads or tails from it. Because there are, what, 10,000 stocks out there? There's going to be one that's doing something very nice that you can take advantage of. So you do not have to waste your time trading the crap. You trade what adheres to proper market structure, and you trade in a way that provides a path of least resistance. So the 5 simple value rules. Number 1, buy when price is undervalued, discount. Sell when price is overvalued, premium. Buy when prices are trending up, mark up. Sell when prices are trending down, mark down. And lastly, avoid trading during periods of accumulation or distribution. What I love about these 5 simple value rules is that it's telling you a concept. Buy, discounts, sell, premiums. Then it's telling you when to do it. Only do this during a markup phase, only do this during a markdown phase, and then it's telling you what not to do. Don't try to trade periods of accumulation or distribution or any of the other muck that you can't understand. These 5 rules you can carry with you, and if you do these rules, simple. It can be as easy as you want or as hard as you want. I prefer to make it as easy as possible. All right, now we're going to get into the meat and the tail half of this course, part 1. And we're going to talk right now about identifying value opportunities. We just talked about value, discounts, and premiums, and how that relates to what we're doing. Now, how do we identify value now? How do we identify value opportunities? Your ability to quickly and accurately identify value opportunities, that's what sets you apart as a trader. And when you can set yourself apart as a trader that can accurately identify value opportunities quicker than the next guy and more accurately than the next guy, you know what? You've become a pro trader that makes more money than the next guy. Identifying value opportunities can be both easy and difficult, right? Because remember what we talked about value. It's easy. During a markup phase, we know when there's a discount, those pullbacks. That's easy. But it can also be difficult because remember, value is the dominant variable in the market. It's always changing, and every time frame has value, etc., etc. What you have to do is make it easy for yourself. Once you master a few simple concepts, you'll be able to easily identify value in any chart. Any chart. You won't even need an indicator if you don't want it. You can just have pure price, pure volume, and you can look at that chart and know what to do. When you're able to identify discounts and premiums, limit your trading to only these opportunities. Remember, limit your trading to only the best opportunities, the high probability opportunities that provide a path of least resistance. So here are the tools of the trade. These tools of the trade we're going to carry with us throughout the rest of the course, and we're actually going to have some very detailed entry techniques and detailed setups as a result of these 3 tools of the trade, especially in part 2 of this course. But right now what we're going to do is just introduce the tools, not so much how to enter and exit using them, but we're going to introduce the tools, we're going to look at them on the charts, and then we're going to explain the nuances of using these tools for what we've just discussed. So the first one is going to be PEMA. And the PEMA method is the pivot-based exponential moving average method that I created and is basically available as a free download as a 50-page free ebook from my website. And these pivot-based exponential moving averages, everyone has access to. Even if you don't use the pivot-based portion, even if you just use a normal calculation of exponential moving averages, or even if you use a simple moving average, it doesn't matter. You have access to moving averages. I'm going to show you how to use them and use them in the right way. Moving averages are simple. Everyone has access to them on their trading platforms, and they're very easy to help you identify the trend and subsequently its value opportunities. And the best way to use them are when they're stacked and sloped. And I'll show you what that means in a little bit. The pivot range is going to be the other thing we use here. This pivot range I talked about in my book, Secrets of a Pivot Boss. And of course, Mark Fisher introduced the book and introduced the pivot range in his book, The Logical Trader. And basically, this pivot range we're going to use as a method for identifying monthly value areas. And by using those monthly value areas, we'll be able to identify those zones that are ripe for the best buy the dip or sell the rip opportunities. If you can do that using this indicator, you can go very, very far. And lastly, I'm going to introduce volume weighted average price, or VWAP. And this is a classic indicator that basically reveals a real-time value line based on actual transactions. It is one of the most powerful tools available to traders, and that's why I built an entire module around it. I probably created the most functional, versatile, flexible, customizable VWAP indicator you've ever seen at my prior company. And that's why I truly believe in this indicator. But the one that you have will suffice just fine for the most part. And I'll talk about what sets the VWAP apart from other ones when we get to that section. But basically, this real-time value line basically just gives you, it's almost like Cliff Notes. It just gives you quick and dirty, this is value. And all you have to do is look at, is price going up or is price going down? And you know exactly where to buy and sell. If price is going sideways and the VWAP line is flat, well, there's no edge, but you can still identify those discounts and premiums regardless. These tools can help you identify some of the best swing trading opportunities in the market. You just have to use them in the right way. And I'm going to show you how coming up here in the next section and also in the parts 2s and 3s coming up. So identifying value. This is Kimberly Clark in a daily chart, and this is the chart we're going to look at here for the next few slides. Every time you look at a chart, this is just a very clean price chart. Your goal is one of two things: either to identify periods of accumulation or distribution that are ready to transition into a markup or markdown phase, or to identify an already established, currently in the markup phase, a stock that's already established and currently in the markup phase or markdown phase. If you can do that, then all you have to do is use the tools of the trade to identify the best action zones. Here's accumulation and the markup that followed. So if we're looking at this with pivot-based exponential moving averages, it looks like this. During the markup phase, every pullback to the first and second levels of the PIMAs offer great value opportunities. So here's the accumulation phase. We got the breakup. Now we have our 3 pivot-based exponential moving averages. And I use 3 because the top one gives me the short-term, medium-term, and long-term lines of that trend. When the 3 are stacked and sloped, meaning they're all trending higher in unison, that offers the best time to trade. And the best opportunities are a result of a stacked and sloped environment. It's easy to see that every test at the first 2 lines, those are the discounts. The new highs within the uptrend are the premiums. You want to buy the discount and sell the premium. Buy the discount, sell the premium. Buy the discount, sell the premium. And because value is such a different thing, remember we talked about value being the dominant variable in the market and also value being different in any time frame. It's all about, it's all relative to what has just happened. Look at this right here. This is a premium and this is where price is. Now look to the right. Price is at the exact same level, but it's no longer considered a premium. It's now considered a discount. It's all relative to what has happened. And this is a discount compared to recent price being here, not as a result of price being here. So it's all relative and it all works just the same. You just have to be able to identify those periods that offer the best entry and exit points. Now, if we look at the next chart, or the next slide here of the same chart, now you have the pivot range. The pivot range are these three lines, and these three lines are created by using the high, low, and close price information from the prior month, and those gives you the levels for the upcoming month. So now if you use the high, low, and close for May, it gives you the levels for June. And you can see there are various widths associated to it, and we talked about pivot width analysis before and how it helps you identify periods of contraction and expansion. But also, it's important to note that these pivot ranges are value areas. That's how I see them. I see these as value areas. Because of this movement here, the formula or equation for the pivot range says value is from here to here for the upcoming month. And you can see how price adhered to that value. If price had broken below there, that's an indication that there's no longer support from buyers at that zone. They're no longer confident or comfortable with the fact of price going up. And if price had closed here and broke down below it, we would be headed lower. But the market instead adhered to those concepts of value, and we got a very nice up move. So these value areas, I've even shaded them kind of green here to let you know that as long as price remains above the pivot range, every pullback, whether it happens here at the pivot range or not, is a buying opportunity. And lastly, the last tool of the trade is VWAP, volume weighted average price. So during an established markup phase, price will test VWAP to reaffirm direction. Which usually welcomes responsive buyers that are eager to buy at a discount. Pullbacks to VWAP during a strong markup phase offer great value opportunities. This is a quarterly VWAP. That means at the first day of the quarter, right here, the first trading day of April, VWAP starts to calculate after the first tick occurs. And as price continues to develop, the VWAP line continues to develop. So this is the startup phase. We're not looking to buy or sell during the startup phase, but once an established VWAP line has developed, then it becomes the value line to watch. So a test right here, that's a buying opportunity. And you know what? Given the entry techniques that we're going to cover in part 2 of this course, you'll be able to get in right there. And if you get in right there, you're a couple of ticks from the bottom of that move, and I'll help you identify sell targets along the way so that you can capture this move. That is the power of understanding these concepts and having confidence in the tools you're using and understanding how to use those tools to the best of their ability. All right, so now that we've just gotten an introduction to those 3 tools that we're going to use the rest of the course, we're going to look at those 3 tools in more detail in the next 3 sections of part 1. The first one that we're going to cover is pivot-based moving averages. So, PIMA. The pivot-based exponential moving averages provide an easy method for identifying value opportunities during trending markets. Using moving averages has been around for decades upon decades. Professional traders, institutional traders, hedge fund managers, they've used these for a long time. It is a classic traditional approach. The problem is most retail traders don't quite know how to use a moving average. I know when I first started trading, I completely looked at moving averages in the wrong way. And because I was looking at them in the wrong way, I deemed them basically useless to my style of trading. But now that I understand market principles much better than when I first started 14, 15 years ago, I I understand their value and how to use them to my advantage. And now, a simple one or two or three moving averages can help you identify amazing opportunities. You just have to use them right. So here's the goal. To use 1, 2, 3 moving averages, I typically like to use a 13, 34, and 55. I give you other variations here on the next slide, but this is usually what I use. That's my cure-all for everything I'm doing, for the most part. And when you have a premium, price is in a markup phase and moves up to a premium, you can sell that premium back toward the moving averages. That's called a mean reversion trade. Or you can wait for price to come down into the buy zone, the trigger zone, and this move right here, this test, the successful test, can and will lead to a bounce up to new highs. This is your action zone. This is the action zone. My goal for you is to be able to get in as close to the bottom of this candlestick as possible so that you can maximize your move with the smallest risk possible. And when the MAs are stacked in slope, it provides the best potential trading opportunity during a markup phase. So pivot-based exponential moving averages visually reveal value opportunities during trending markets. Again, simple and accessible. Everybody has access to them. They're simple to use and understand. Multiple moving averages help you to easily identify the trend and the value opportunities. And again, I use the short term, medium term, and long term. So a 13 period, 34 period, and 55 period moving averages. And when they are stacked in slope during an established markup or markdown phase, it's like shooting pullbacks in a barrel. So getting started with pivot-based exponential moving averages. First of all, if you don't have my free ebook at pivotboss.com, go ahead and get it. It's a 50-page ebook that used to be part of my actual book, Secrets of a Pivot Boss. It was a chapter in that book. I removed that chapter because I felt like the concepts have been talked about before, and I wanted completely fresh material in my book. And I decided to take it out, make it free so that you can understand my writing style, understand where I'm coming from, and have some actionable concepts that you can profit with if that's the only thing you read from me. So I would check out that 50-page ebook, and it gives you a head start on these pivot-based exponential moving averages. The one thing to keep in mind is that what makes them pivot-based is the fact that the input for the moving averages uses the pivot point, or commonly known as typical price. And typical price is the high plus low plus close divided by 3. That's the input. It's up to you because some trading platforms don't allow you to input the typical price. Some do. Some platforms allow you to create the indicator using an easy language type script. And that's what I did for my trading platform. I just created some standard VBA quick code and created this indicator myself. It's very simple, but you don't have to. You can use a normal moving average if you want, with the normal standard close price as the input. It's up to you. Also, I like the exponential moving averages more than the simple, just because I feel like the fact that the exponential moving averages are faster than the simple moving average, I feel like that gives me a little bit more of an edge because they're faster. However, institutional traders, hedge fund managers, all the big boys, the big traders that I know on the floors of the exchanges, they use simple. It's been around forever. It's a classic approach, and they want to see what everyone else sees. I'm not that style of trader. I don't use what everybody else uses because they're using it. What I do is use what makes sense to me and what I'm comfortable with. So I use pivot-based DMAs, but it's not a requirement. So if you want to use simple, if you want to use exponential, if you want to use a pivot-based EMA or a standard close price, it's all up to you and what makes sense to you. Lastly, trend intensity. Every trend is not created equal. Some trends are parabolic and never have pullbacks, breakouts that just rally. Those high intensity trends, adjust your moving averages to accommodate them. Instead of using My classic 1334.55, use an 8.1321. If it's a medium intensity trend, use 1321.34, and that will give you a nice basis for how to trade that trend. If it's a low intensity trend, use 1334.55. Also, if you're not tailoring the moving averages to the intensity of the trend, just use 1334.55 as the cure-all. And that gives you a very nice umbrella to just use over and over. And if during using that 1334.55 you notice that the trend you're trying to trade is has a higher intensity or a lower intensity, then you can adjust accordingly. But for the most part, most of the examples that you see me use will be 1334.55, if not all. Now let's talk about PIMA analysis now. We have our 3 moving averages on the chart. Now what? We're going to get into actual setups and actual entry techniques in part 2 of this course, but for now, I want to give you the basics on using these indicators. 1, 2, 3 moving averages, short term, medium term, long term. Number 1, the long term moving average, you never want price to test it. You want price to stay in the first 2 levels every time. Okay? So because this is the overall trending moving average, when price comes to this moving average or closes against it, that's almost a surefire way to know that the trend is over. So you never want it to come over here. You don't want to play a pullback off the bottom moving average. As a rule, that doesn't mean it can't work or it doesn't work. It's just as a rule, you want it to bounce at the first 2 lines. Secondly, you want the moving averages to be stacked and sloped. They're stacked, which means the short term is at the top, medium term's in the middle, and long term's on the bottom. That's how it should be. They're stacked appropriately and they're sloping upward. If they're sloping upward, that means you have a very nice markup trend in process, or sloped downward, a very nice markdown trend in the process, and that will give you your typical market structure, and you know how to trade that. You buy the dips at the discount opportunities and you sell at the premium opportunities. All right? The next thing, for the most part, you want to be able to buy at the center. You want to buy the reversals off the center because that tells you that you've had a decent pullback and the trend is trading in a way that it should, meaning higher highs, higher low, higher highs, higher low, higher highs, higher low, higher highs, somewhere over here, higher low, and then the trend kind of breaks up after that. But you want to be able to know what to expect. You want it to be typical price behavior, and that means coming back to the center line. Now sometimes that won't happen and instead you get a bounce off the top, and that's cool too. That's perfectly fine. You just have to know what to expect and how to play those opportunities. But these discounts, over and over again, those are the buying opportunities. These premiums, over and over again, that's where you liquidate your trade. You hand back your position and take your profits, and you wait for the next one. So value opportunities always exist during a markup phase, when the PIMAs are stacked and sloped. And basically, during a markup phase, you're going to get pullbacks along the way, and your goal is to identify those pullbacks during a stacked and sloped environment. But when you see that buying climax, which is right here, do you see how this is just normal up move, then bounce, then normal, then bounce, then normal bounce, then normal move, and then boom, you get a big move, and then you get that buying climax that pushes to the top, and then boom, slams to the bottom, and then you have the automatic reaction to boom, slam down to find the base there, and then the automatic reversal back up. This is a classic pattern for building out a distribution phase. That is the onset of distribution, which means the trend is now over. So if you're trading these happy little pullbacks for several months, and then you take your profit up here and you see this happen, this is not a discount buying opportunity. Stay away. This is now the beginning of distribution. Go find something else. So buying discounts on the way up will work, until they stop working. Just like personality of markets theory, a well-behaved stock will continue to be well-behaved until it proves otherwise. This right here, the markup phase will remain into the markup phase until it proves otherwise. This buying climax is the first cue. This automatic reaction is the second cue. This bounce back up is the third cue, and then you begin to see the box build out. All right. Using these moving averages, you're going to see the whole transition from accumulation phase to markup, or from distribution to markdown. You just have to understand the transition, what to look for, and then get yourself positioned to do the right thing. So here's a phase of accumulation, and then when price pushed up through the top of that accumulation phase and price pushes up, you see the short-term moving average begin to cross over, and eventually it crosses both moving averages. That's the first goal right there, is the initial crossover. But you can see here, we're still not stacked and sloped, and the medium-term moving average hasn't quite moved yet. But on that first pullback, that's the first pullback, that's the first retest. The market is retesting now. It's saying, okay, we just got a big move. Now we got some people taking, selling a little bit, selling those profits, and we need to test whether we're going to get buying support down here. Because if we can get buyers to join the party, we are officially out of this phase, and we are officially in party mode during the markup phase. So this first retest is your first buying opportunity. Look at how it holds as support at these moving averages, and how it also holds the prior trading range. And then boom, once you get that move, that second one is an easy opportunity to get long again, and then you see the market go to a stacked and sloped view. The moving average is there, and then these bounce opportunities become prime opportunities. But just understand the flow of how it works. Lastly, you got to know the personality of what you're trading. Every stock's going to have a different personality. So a buy the dips move in a certain issue is going to be different than the next issue because of the personality that stock is going through at that moment in time. Number one, it needs to be stacked and sloped. But look at this uptrend right here. This markup phase is different than most. It's just very calm, short-term move up, bounce. Nice short-term move up, bounce. Nice short-term move up, bounce, etc., etc. It's a very slow and steady process. There's no huge home run trades, but it's a lot of doubles and triples. You're hitting base hits. And that is good. That's all you need. But you just have to understand the personality and tailor that approach. If I know that each of these moves is only yielding 3 and 4 day moves, then when I buy here, I know that on this wick right here, after this 4-day move, is probably the top, short-term top I'm getting out here. So don't try to play to a move that's at 53 if you need to be playing to 50 half. Secondly, once you get that adverse close and you see this rounding off behavior, yes, we got that bounce up because that was a discount, but this signals that the market structure that you just enjoyed is transitioning. So you can no longer trust what happens now. And instead, this is becoming a distribution phase. It's a rounded top. You get some mess here. And this probably leads to the transition into a markdown phase. Look at how the crossover right here, the short-term moving average crossed both of them. And now the medium term is starting to make its way down. I'm not quite sure what happened to the right of the chart here, but this right here looks like a very bearish opportunity. I would sell right now and try to buy it back around 48. That's kind of what I'm looking at. So all of you can go back to November of 2012, which was a few months ago, to see if what I just said is correct. But this is what I'm betting would happen. But that's just the initial crossover. And that is even though the markdown and markup periods are the best times that offer the best times to trade, the initial transition can be tricky. So this is the hardest part of the entire phase. But if you get this part right on the initial move, you're going to have money the rate all the way down. Now this is a chart that you need to understand can happen and does happen. And basically the symmetry and structure of this trend, the geometry of it just doesn't work as well as it could. I mean, you can see right here that there's no stacked and sloped right here. It's more sideways, but price is still kind of moving up. Then the slope becomes a little lazy and it becomes better, but it's still lazy. These pullbacks still offer a decent opportunity to buy, but it's not perfect. And then you get the explosive up move, almost a parabolic up move. Well, when price comes back off of that parabolic up move, this isn't a discount buying opportunity. Yes, it is a discount compared to what's happened. It's a deep discount. But this move is so emphatic. This move is so explosive here. There's too much distance between your overall trend EMA and where price was, that this reaction right here is just something to stay away from. Don't try to buy the dip here because it's not likely to work out. Something's going on here and you have the rubber band effect instead. That rubber band effect could lead to an overall transition that leads to a move down or a sideways move. This is not a great markup phase. Yes, it did lead to some great moves, but there's other opportunities that are better. Like this one. This is a very nice markdown phase, stacked and sloped. Here are your discounts. Discounts, discount, discounts, right? Discount. These are your discounts. That's where you're covering your short trades. These are your premiums. Boom, 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 boom. This is where you sell. So you try to get this quick move down. You try to get this quick move down. Now, when you fail to make a new low, that's rule number one, that you're either stopping going down and going sideways, or you're probably just going to turn around and go up. And you can see that when we bounce back into the EMAs, no selling occurred. Instead, you crossed above them and the game is over. And now you're either going sideways or you're going to go up. But you're not going to go down. At least not for the most part. And even if it does, it's not in the right structure for you. Just go on to the next one who is exhibiting proper trending structure. All right, now that we've covered the PIMA approach and the 3 moving averages that we're going to use for that approach, we're going to talk about the pivot range analysis now. The pivot range analysis, for those of you that are familiar with the pivot range, you should be very familiar, especially if you've read my book, read my analysis on my blog, some of the other courses, etc. Pivot range analysis should not be new to you, but I'm going to tailor the concepts and the ideas around to this course so that you can begin to mold the concept of the pivot range into something that really helps you in swing trading. The pivot range is a multifaceted indicator that reveals value areas in any chart and time frame, and that makes it easy to identify great bargains in the market. The pivot range is one of my favorite indicators, always has been, ever since I read Mark Fisher's book. And of course, he uses the pivot range in a much different way than I do, but the range is so multifaceted that you can use it in so many ways. And when you have an indicator that is like a Swiss Army knife and that it has a variety of uses, you have an indicator that you can always use and serves a greater purpose than other indicators that only have 1 or 2 uses. And that's why I love this pivot range. The idea here is to identify buy and sell opportunities during established markup and markdown phases, and to buy reversals at the pivot range on the way up or sell reversals at the pivot range on the way down. For the most part, you want higher and lower value relationships for these opportunities, which means you want this pivot range here to be completely higher than the last month's pivot range. That is a trend where value is moving higher and higher month over month, and that indicates a more robust trend, whether it's up or down. Again, this indicator is simple, it's easy to understand, easy to calculate. I can give you a spreadsheet that easily calculates these numbers, or You can download indicators into your platform. Some trading platforms have the pivot range already built in. It's very easy to have these written for you, and I can help you attain the pivot range if you use various platforms like TradeStation or NinjaTrader, etc. I can help you find that indicator, so let me know if you're having trouble finding it. The idea is to buy the rips and sell the dips, or buy the dips and sell the rips rather, in a markup or markdown phase using this indicator. So getting started with the pivot range is a simple indicator, and it can be used and calculated with a spreadsheet, but it is not commonly included in trading platforms. It can be in a trading platform though, because other traders like you and me have loved the indicator and have had it either created for them or created by them in order to put into their existing platform. So again, if you're having issues trying to find it, let me know and I'll help you. The pivot range is basically 3 lines, and you use a prior periods of times high, low, and close price information divided by 3 in order to find the actual pivot point. And then you use high plus low divided by 2 to get the other level of the pivot range, either the top or bottom. I call it BC, which is bottom central pivot. And that number helps you identify the third level. So this is the pivot minus BC, which is this number. So the pivot point minus this number gives you a value. And then you add the pivot to it, and that gives you TC, which I call top central pivot. So this is the center line, this is the top line, this is the bottom line. It's important to note that depending upon what price has been doing, sometimes the bottom line can actually lead to, the bottom line calculation can lead to the line that creates the top line, and this calculation can give you the bottom line. So bottom central and top central are not set in stone, but that's what I call them because generally that's the way they look. What's great about this indicator is that it's flexible, super flexible. You can use it for any time frame that you want. You can use it for daily, day over day, week over week pivot range, month over month, a yearly. So last year's high, low, and close gives you the pivot range for the upcoming year. You can do a 3-day rolling or a 2-day rolling, 5-day rolling. There's so many ways you can use it. What we're going to do for the most part in this course is use monthly. Last month's high, low, and close information will help generate the pivot range for the upcoming month. Lastly, pivot-based analysis. The pivot range can be used in many types of analytical ways. Trending analysis, width analysis, relationships, and that makes it, again, an indicator that you want to have around when you can use it in a variety of ways. So when we're looking at pivot range analysis here, the pivot range helps you keep discipline to the trend. What does that mean? It means that if the pivot range is trending higher and higher and price remains above that range, you should only trade in the direction of the trend. You should only be buying, 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 buying. You should not be selling unless it's selling to liquidate your long position. Trend integrity. It helps keep you disciplined to the trend. If the value via the pivot range is higher and higher, that means price is in a markup uptrend, and you should be looking to buy those pullbacks on the way up. Keeps you disciplined to the trend. Every one of these pullbacks is a retest of value, and when value continues to hold, it helps the market stay focused to the upside price discovery at hand. When it gets this pullback and it remains above the pivot range, that's still a good discount buying opportunity. So the goal here is to buy discounts. Price tends to remain above the pivot range during highly bullish markup phases. And when it does, every pullback to the pivot range, you buy that discount. You buy this discount. You buy any of these discounts here, because that's what you do during an uptrending market. After price breaks out from the accumulation phase, you're likely going to see a markup phase. All you have to do is identify when to buy and sell on those pullbacks and at those premiums. Each test at the pivot range is the market retesting value. It's a reassurance. It's what the market does. When you have this distribution phase right here, giant distribution phase and a downside break, what did the market do right here? First, it came up to retest value. Price comes up and it's saying, okay, traders, what do you think about price being right here? Instead of more buying happening, sellers piled on. Well, that's all we needed to know. Let's move down. Price moves down. Okay, now let's retest that prior value and see what people think. Oh, more selling. Okay, boom, let's go down. Retest value, drop. Retest value, drop. Retest value, drop. When it comes up and it retests value, and instead of sellers piling on, and it closes above the pivot range for the first time in months and months and months, that adverse close tells you that the markdown phase is likely over. Go find something else to trade because price is likely either headed sideways or up from there. And you can see as a result of this close price above the pivot range for that month, it led to a development of the pivot range that was higher than the prior month, and now you have a 2-month higher value relationship, whereas before they were all lower and lower and lower. That's how you can see the change in that trend, in that markdown. You're literally seeing the transition from markdown to either markup or accumulation. Here's another example here where you have a very distinguished distribution phase, which leads to a glorious markdown phase. Here's an inside value relationship, which is one of my favorite setups ever known to man. That's when the value area via the pivot range develops inside the value area or the pivot range of the prior month. That usually leads to a breakout move, and that usually sparks your markdown period. Now this can form back here, but it's not going to work out because the development is still occurring. But when this occurs during a phase where a breakout can't happen, that's the one you need to pay attention to. After a couple of months of doing that, this is perfect. We get the downside move. You want to sell a premium. That first pullback, that's when you get short. You can get short as close to this pivot as you want, and now, boom, you're in the move. And as soon as you see an indecisive candle down here, that's likely your premium, and you're going to see a pullback. You liquidate and cover your trade here. You make a very nice move. When price pulls back, that's another pounce opportunity for you to get short. Here's a pivot range where you can see the transition is seamless at times when you have well-behaved stocks. This will never happen in a volatile, unstructured chart. Instead, this is a well-behaved stock that is adhering to typical market principles of markdown, accumulation, markup. Look at the pivot range stay above price. Pullbacks to the pivot range are easily and quickly sold. And then price closes adversely to the pivot range here. Then you get a higher value and another higher value, and you're getting these bounces at the pivot range. These all of a sudden, these turn into discounts, and now you're in a markup phase. So you can see how literally the pivot range can light the path. Lights the way. It tells you exactly what to do and where to be focused. Any pullback can be regarded as a buying opportunity as long as price remains above the pivot range. It doesn't even have to test the pivot range. I mean, here's your phase of accumulation. Here's a beautiful, glorious uptrending market, a markup phase. This pullback is the retest of the phase. That's your first initial pullback. This starts the trend. Remember we had that a few slides back? That starts the markup. This didn't happen at the pivot range, but that makes it no less perfect of a time to buy. By the way, here's another inside value that led to the breakout. But here's an inside value that didn't, because that was during the beginning portion of that accumulation phase. This one did. So this pullback is still a great pullback, even though it didn't happen at the pivot range. But this pounce right here is surely confirmed because it happened at the pivot range, and you can see these moves as they occur away from that range. Now that we've talked about the pivot range, it's time to talk about volume weighted average price, VWAP. And VWAP is a powerful indicator that clearly illustrates where the average trader bought and sold, thus revealing fair value. What's impressive about this indicator is that it is an indicator that gives you a running tally, a real-time tally of value based on actual transactions, based on actual buying and selling, and the volume traded. So volume weighted average price reveals a real-time value line. It's a very simple indicator to use and decipher. It's semi-accessible, which means it's commonly used, it's all out there, but a lot of people don't even know they have it, and some people don't have it but can get it. Again, I try not to teach anything to you that I don't believe you can get fairly easily, and if you're having trouble finding VWAP for your platform, let me know, and I'll try to help you as best I can. But it's an indicator that's very, very accessible by most traders. VWAP offers a real-time view of value, so any value levels above or below it are easily identifiable. And that's when you're able to buy the dips and sell the rips during a trending market. So getting started with VWAP, volume weighted average price, is a powerful indicator that many high-level professionals use daily. As a matter of fact, I've read research that suggests that upwards of 90% of program traders and institutions use this VWAP calculation because it's that important to what they do in their trading. This indicator is oftentimes a standard indicator for many trading platforms, but one thing that isn't standard is the ability to customize the indicator. The flexibility of the indicator is not quite there or on the par from trading platform to trading platform. Some may have just a normal standard VWAP. Others will allow you to customize it in a variety of ways. The one that I developed for my prior company was one that allowed you to adjust the time frame that was calculated for it. So you can make a 1-day VWAP, so you know what's going on in that day in a 1-minute or 5-minute chart or whatever. But you can also make a 2-day or 3-day calculation. Or you can make a weekly or a monthly or a quarterly calculation that it uses over a 3 or 4 month period of time. Or you can make a 6-month calculation or a 3-day rolling or a 2-week rolling, whatever you want. It's up to you. That is where the flexibility is not quite there between platforms, but it's not quite required. Not for this course. As long as you can get a higher time frame VWAP calculation, it'll help you identify those buying and sell opportunities. This is the calculation. Very fancy math looking calculation, but it's not that difficult underneath it all. Basically, the indicator calculates the ratio of the value traded to the total volume traded. That's all it's doing. But it's doing it in a way that makes sense and that helps you identify great opportunities. VWAP can be used in a variety of ways, but identifying value is tops. And the idea here is you buy at or below value in a bull market, you sell at or above value in a bear market, and in a neutral market or trading range market, you sell above and buy below. It's that easy. It really is. Let's look at some charts. The VWAP matrix. The VWAP matrix is something that is a graphic that easily shows you what the common thought process is of the professionals that use this approach. The professional traders, program traders, institutional traders, they use VWAP. This is their rules for engaging VWAP. These are the commonly accepted rules and results that occur as a result of these rules. The VWAP matrix basically shows you that if you buy below VWAP, generally it's going to lead to a profitable trade. The idea behind that idea is a profitable trade, basically. If you sell above VWAP, that's generally considered a profitable trade. If you sell below VWAP, that's aggressive selling, sparked by initiative participants. If you buy above VWAP, that's aggressive buying, sparked by initiative participants. So you can see here again, you can cut these out, paste them on your fridge, show them to your kids, explain to your wife that this is what you do. Action, buy below. The result, profitable trade. Action, sell above. Result, profitable trade, etc. This basically gives you a handy little lookout of how to use this indicator. So if we look at some charts now, you can see that VWAP analysis here shows a dotted line. I'm using a quarterly calculation, which means that it's 1, 2, 3 month period calculation. Right? That's what it is. 1, 2, 3 months here calculated. It starts here. This one ends here and it goes backward. That 3-month calculation kind of gives me the flow of higher time frame value in real time as VWAP continues to develop. You can see here that in this period of accumulation, it's basically a trading range type of market, and VWAP is flat. During a flat market, any level above it, above VWAP, that's a premium. Any level below it, that's a discount. You can always trade if you have VWAP on your chart, no matter the type of market. Now what we're going to use it for is during that markup phase. When VWAP is trending higher, a move into VWAP should be seen as a buying opportunity. A move away from it will be seen as a premium opportunity that you'll sell. And when you drop down into VWAP, that's a discount that you buy. When it rallies away from that level, that's a premium that you sell. You're going to identify these zones time and time again using this indicator. That's the goal. You can see here that regardless of the trend, VWAP will always show you where fair value is on the chart. Your goal is to identify that fair value in a trending market and then either buy at or below it in an uptrend and sell at or above it in a downtrend. Now I know earlier, this is very important, I know earlier I talked about this being fair value. And what you want to do is buy a discount, and discounts are seen as below value. This obviously is a tail, and it's sitting and it closed above value. I'm still calling this a discount. I'm still calling this a discount, even though technically price is above value, which makes it a premium. Because I'm talking about this move from here to here that makes this a discount. This is the premium, and now compared to this premium, price is at a discount and it happens to be back at value, which makes it a value. If price is at value, it's still a value. If price is at below value, it's a discount, making it a better value. So even though price is above that VWAP line, to me it's still a discount. This is your buying opportunity. And you can get as close to this line as you want or below it. You're going to be amazed at the type of entries that you can get with the techniques that I'll teach you in part 2 of this course. In a downtrending market, again, this is a premium. This is even a premium. Even though price is right at that line or just below it, it's still a premium because it's a downtrend and it's a pullback off a discount low. You want to identify that level, and that's the best level that you can possibly get in this downtrend, and you capture a giant, beautiful move as a result of it. Now, whether you participated in the prior move or not, that's irrelevant. The pullback to VWAP after that rally is its own opportunity. It's its own setup. So I don't want you to be hung up in the fact that you didn't capture this big move. You had to sit there and pull your hair out as you knew you should have gotten in on this move, and you watched it go from 75 to 82. That has no bearing on this opportunity. But you know what? This beautiful, awesome up move is now pulling back, and it's pulling back precisely to VWAP. And that is your opportunity to get in at a high probability buy zone that will give you a beautiful, quick, pain-free up move as a result for the most part. It's about as good as an opportunity as you can get in any market. That's your discount buying opportunity. And when price rallies to a new high and begins to do this squirrely stuff here, that's when you sell it for a premium. And you move on to the next one. But you know what? This breakaway play right here, this gap out of this accumulation phase, I'll teach you how to get in on that as well in part 2 of this course. And so you'll be able to take advantage of this big move, and then when you sell it for a profit, you'll be able to buy it again right here and sell it for a profit. I'm going to teach you all of this. And it's going to be a lot of information, and it's going to go quickly, especially starting in part 2 of this course. But you'll be able to watch this over and over and over again. So you'll have all the information right there. Here's VWAP analysis here for a trending market where we have a beautiful up phase again. Discounts and premiums are easy to spot with this level on the chart. Everything above it is considered a premium. Everything below it or at it is considered a discount in an uptrending market. This is beautiful. This is the best opportunity on the screen right now. When you have the indicator developing, this is the warm-up phase. You don't really pay attention to it quite yet, but it's coming out of an accumulation phase or a minor accumulation phase, and you get the huge move up. That's bullish. So now when you get this move down, and that's a retest of value, buyers are going to defend that zone. The people that missed out on this move want to participate, and there's going to be an influx of buyers. The people that cashed out here are going to want to re-up their position here. You're going to double, triple, quadruple the buying that occurs. Look at this volume spike. Look at this move up that occurs. This is the spot to get long. That's your discount buying opportunity. The squirrely stuff, after an explosive move up, that is your premium. Sell it. When price comes back to this area, it's a confluence of support, and it's also a retest of value. Buyers jump in, look at the volume, and then you get the move up. It doesn't have to be that difficult. A few great concepts and ideas and adhering to the rules using discipline can help make a world of difference in your trading. Let's look at it here. I talked about it before. By definition, a premium is any price level above value. But this is still a premium even though it's at value because of recent movement. Your goal is to identify these premiums, and not all premiums are created equal. This is much easier to sell short than this is because you're like, what's going on here? Why is it going so far past? I don't know what to do here. Let it go. Don't trade that one. You don't need to. But this one, that's a lot easier to trade. This one, that's a lot easier to trade on the way down. These are your discount opportunities. That's when you cover your trade. Trade what makes sense and what's easy. If it's an easy walk in the park setup, trade it. If you don't know what's going on or you can't understand why price is doing something, you know what? You can reserve the right to punt, just like in football. The best quarterbacks reserve the right to punt the football instead of throwing an interception. Lastly, just remember, if you have an established markup phase in a well-behaved instrument, the market is likely to follow the rules of auction market theory. The market is likely to adhere to the principles of market structure, premiums, discounts, and value. So if you have an established markup or an established markdown, these pullbacks will be buying opportunities. You have to trust it, and you have to get great entries based on it, based on where price is during that structure. I'll show you how to do that. You have to trust that the market does this over and over again. You just have to find those spots. And this is my final thought slide right here. This is moving forward. At its core, profitable trading is all about understanding market structure and value. The rest, that's just technique and discipline. If you can understand market structure and value, all you need now is the technique to get in at the right spots at the right time and the discipline to do the right things over and over and over again and avoid doing the wrong things. That's what this course is all about. We're laying the foundation, the groundwork for you to know what's going on in the market and have confidence in your skills at identifying value. And then we're going to learn the techniques to basically tie it all together and get you those amazing entries and those great exits. The 4 market phases help you understand market structure. If you can understand them, you understand what price is doing, what it's trying to do, and then what it will do. If you can seek out those phases of accumulation and distribution, you will then understand or know when to anticipate those periods of markups and markdowns. Of course, the concepts of value, discounts, and premiums, these are the foundations of when to buy and sell. If you limit yourself to only trading the best opportunities that offer the best value, you're trading in the path of least resistance. You're going to do much better in your trading. So let's learn these concepts from the ground up. Watch this over and over and over again. And then let's apply those amazing techniques that we're going to learn in parts 2 and 3 in order to tie it all together and become consistently profitable. Because if you can learn the methods from this 3-part course inside and out, you'll know how to trade any time frame, from a 1-minute chart to a monthly chart. And that's the goal of this course. And that concludes part 1 of Swing Trade Pro, Foundational Swing Trading Concepts.